Hi traders, in this video we'll be taking a look at the different indices around the world and how we are looking at them from a technical analysis and price action based standpoint. Stay tuned. Before we get started, I'd just like to remind everybody to of course like the video if you enjoyed the content, comment down below if you have any questions, and make sure to subscribe and hit that alert button to receive more daily content during this crisis. So here is the Dow, the US 30, and I start with this chart to discuss the weekly close. As you're probably aware by now, if you've been watching these videos, you've been watching other people's videos, everyone is seeing this potential shooting star, or some people will call it pin bar, on the weekly. And this has always got me concerned because right now, as I've been making relatively negative videos about what the Fed is doing in terms of propping the market in the US, this shooting star, while it is a good technical signal, is not enough to go with. You need to see even more. So the shooting star has happened, and if the market was to break past and get past this level of 25,000, I think it would remain a fairly bullish market. And in fact, we would see bullish sentiment move further up, potentially even to 27,000 on the Dow. While this may not be popular opinion, because many people believe that we are in a bear market and the Fed cannot control it, this is what the price action will be telling us. And if you are a trader, that is what you need to do. You need to follow that price action. So let's deep dive into these indices right now and talk about them. So we'll now discuss the S&P 500, as this is the one that most people are watching. The S&P 500 is giving the bears a lot of technical signals to watch. The first one is, of course, the 61.8 fib, the shooting star, the moving average acting as dynamic resistance, and just the general pullback zone of just below 3,000 being the psychological area. The problem with this is the shooting star, the moving averages, and even the Fibonacci are not enough to move into a position either way on. In terms of expectations for what we have, the bear side would need to see a break below the 2720 zone support for us to consider selling. And this is because while going below here is good, every time we have seen shooting stars on the daily, it has been rejected. So let's jump onto the daily right now. We'll get rid of this Fibonacci as we're all aware where it's been, and we'll talk about this daily. So as mentioned, we have the daily shooting star here, the daily shooting star here, and the daily shooting star here, all of which have failed, and they are all absolute bear traps in terms of the bull market. If the market was to break higher, effectively what we would be saying is okay, we've broken higher and we would be getting through the 200 SMA and the 3,000 psychological point. This would be incredibly bullish, and we'd expect the market to go to the 3,100 and then potentially even test previous levels at around the 3,200. So that's our thoughts on the bull market scenario in terms of the S&P 500. The bear market becomes one of it needs to turn, and it needs to turn right now. We have the resistance here that acted as previous resistance before around the 2880. We've got the high. Some people may say it's been a fake out or fake breakout, all those types of things. And we're getting very dangerously close to seeing a 2050 EMA cross on the daily towards the upside. So if the market is not moving down now, we would expect that further bullish momentum could come in. We would hope that the market would come down like this, break through our 2720 support, of course, by getting through this first support over here at around 2780, and then it would continue down, pull back, and give the opportunity to potentially get into shorts. So if you're on the bear side, that's what we would be looking at. But I think we need to break down this market to even more thought processes. We need to talk about the US 2000. And this is not brought up enough. We did do a video on this the other day, and we discussed the fact that the US 2000 reflects a little bit better the sentiment of the overall market. And this is clearly in a channel. Very clear channel, amazing channel actually. And we are seeing superior weakness from this actual indice. So we've seen a series of highs And every time it's come back down to this trend line here, and we've had the high that's been locked in, we've got the low, we've got the lower high, and we've even got a shooting star here to the short side. But more importantly, we are on a 4 hour at this point in time. And when we think about it, the sell-off that we saw in the S&P 500, look at the reaction to the Russell. So if you're an indice trader and you like looking at different indices to potentially get involved in, guess what? The US 2000 could be the opportunity that you've been looking for in terms of the bear side of the movement. Instead of looking at the S&P 500 like every single person is, why don't you consider, well, we are trading the top 2,000 companies. How many of those can the Federal Reserve actually save? Can the Federal Reserve even get their stimulus to many of these companies? Now, they're definitely trying, but they're not doing as good a job as they are of propping up the top 30 or the top 500. And that's the premise of today's technical analysis video. We all can see these highs. This channel in particular, if you're not seeing that, well, pay attention to it. But if we're breaking through this channel at the same point as it gets below this zone, we will be making a lower low and technically having a change of trend on the price action. We'll also have a 4 hour 2050 cross, and we'll be getting through a key level of 1220 in terms of support. So there's so many things going in the favor of the short side to the Russell 2000. And that's why I think it's the more interesting index to actually look at from a trade perspective. If we break down this concept even further, we can go to things like the Euro Stoxx. Look at how the Euro Stoxx has reacted. Again, when the US sold off, the sell-off was more severe and the pullback is not as pronounced as what we're seeing on the S&P 500. The pullback on the S&P 500 is more bullish sentiment than the Euro Stoxx. What about the support? Let's have a look at the support here on the Euro Stoxx. An absolutely amazing level, 2780. And this gets the point of why you should be looking at more than just one index or one indice kind of grouping. Look at the value or the opportunity that you have to short this. Now, if you're a bear on the S&P 500, why does it matter if you're shorting the S&P 500 or you're shorting the Euro Stoxx? You're still shorting the economy as a whole. If you believe in the idea that there's all these things going wrong, well, guess what? It's going wrong in several markets. So if you've got the Fed, who are relatively rich in this case and spending trillions, will the Eurozone be able to support their companies as well as the Fed has? And the answer is generally no. If we look at the GFC, they were not able to bring back their index to previous highs very easily. It took a long time. So when you're considering which is the weakest economy, that should be really the decision you make. You can get access to trading these pairs. You can get access to trading all sorts of different markets, but the same premise applies. So price action is key, but at the same time, find the best technical analysis and then trade that. Here, the Euro Stoxx looks amazing. Imagine getting through this 2780 area. Amazing support. German 30, very similar setup than the Dow that we looked at. 30 companies in this case. Shooting star, coming off a Fibonacci kind of zone between the 50 and the 61.8. Strong support over here at around this 11,200. And then, of course, it's shorted off. And now when we break it down into the smaller time frames, we might be able to see very similar kind of support zones that we need breaking. The thing I like about this one more than the other pairs was look at the resistance levels, which became support levels, which means that when we get this market break, and if we do get this market break, it's going to be a stronger break. We've got clearer levels of support and potentially not as manipulated index. So very, very interesting trade. German 30, definitely one to watch. And that brings us to, I guess, the end of the technical analysis. There's so much out there, but this is how you want to do it. You want to think, okay, where am I going to find the best opportunity? And then we want to break it down to a daily, 4 hour, weekly kind of concept. And we want to look for key support resistance areas. Then we can bring in our indicators. We can bring in our other reasons. But firstly, we must identify the best markets that we want to trade. Here we have just some quick sentiment charts. I'll get some better ones for the channel. This is a quickly shot video, but effectively this just shows you that the sentiment is pretty bad right now. Sentiment's obviously very low. Sentiment went incredibly high, and then sector sentiment is very different between sectors. So here we have staples doing quite well. If we click on discretionary when this loads, look how poor the sentiment is for discretionary. And it makes sense. People aren't spending. Discretionary as a whole is not doing well. So sentiment trading, or knowing about rotation, the idea that certain markets are hot and certain markets aren't, and they go through phases and these type of things, is a very important lesson that you must learn as a trader and an investor, probably more as an investor. So that's a video for another day. Make sure you like, comment, and of course subscribe and hit that alert, and we'll see you in the next daily video. Bye everybody.